In 2024, the government of Canada started borrowing vast amounts of money to purchase mortgage-backed securities. And now these securities are an investment that takes thousands of consumer mortgages and bundles them all together, then sells them to investors, offering a return, while also taking the mortgages off the books of Canada's big banks, allowing them to lend to other Canadian home buyers all over again. And last year, the government purchased just under $30 billion of these mortgage-backed securities, and they borrowed that $30 billion in order to specifically invest in the mortgage-backed investments. And this year, the government plans on doing that all over again, borrowing an additional $30 billion to bring the total dollar value they own up to $60 billion, with their balance expected to expand to a whopping $200 billion in the coming years. Does this put Canada at risk in any way? Now, it might sound similar to elements that led up to the great financial crisis in the States, but there are some key differences here, and I'm concerned about it and the dangers of borrowing money to make these kinds of massive investments. If you're not familiar with how Canadian mortgage-backed securities work, well, it's actually really simple. A big bank will give out mortgages to people who want to buy homes in Canada, and they'll give them these mortgages at different interest rates. Now, these big banks are thinking, well, we've got to keep a certain amount of cash on hand in order to give it to our depositors when they want to sort of take money out of their bank. So we can't really lend out tons and tons and tons of money while we're still liable for these mortgages. So what they'll do is they'll try to get these mortgages off of their books, and they'll do so in an interesting way. They'll package up all of these mortgages into a mortgage-backed security, essentially a piece of paper that says, hey, if you have this piece of paper, well, then the interest that were paid before from these mortgages, well, that interest is actually going to go to you, and it's going to get paid out through this instrument that is a mortgage-backed security. The investors will say, hey, that sounds like a pretty good deal. I'll give you a bunch of money to buy these mortgage bonds off your hands, and I'll get paid this 4% interest rate or whatever the interest rate is on that mortgage-backed security. This infuses the big banks with a bunch of cash, and if they have more cash, then that means they have more ability to lend out further to more prospective home buyers who might want to get a mortgage with them. Now, there are a couple nuances to this, but this is all you really need to remember. Those nuances are that the big banks don't sell directly to investors usually. They sell to a CMHC subsidiary called the Canada Housing Trust, and that Canada Housing Trust will then package these mortgage-backed securities as something called a Canadian mortgage bond, and that's ultimately what will be purchased by investors. And in this case, what we're talking about today, the Canadian government buying up half of the entire supply of these types of bonds. Now, this is all well and good. Investors get a bond that's guaranteed by the government of Canada. We'll get to that in just a second. And the big banks end up getting their mortgages that they've issued off of their books, allowing them to extend more mortgages to more Canadians. But things start to get really, really questionable when the government becomes the primary buyer of these mortgage bonds, putting the government of Canada more into the role of a hedge fund manager than a government. Now, I really think you're going to find all of this interesting, but first I want to take a few moments to thank the sponsor of today's video, and that's Moomoo, an investment platform that you can use to help save on some of the many taxes that we pay in Canada. Now that it's 2025, it's the perfect time to think about how to maximize your investments and take full advantage of tax benefits. Now, one of the best ways to do this is by using something called a registered investment account, the most popular of which are tax-free savings accounts or a registered retirement savings plan, which can help you save on taxes not just for this year, but also retroactively for last year and moving forward into the future. And Moomoo is a great place to open these types of accounts. A tax-free savings account is a registered account that allows your investments to grow tax-free. Now, if you've never opened up a TFSA before and you're over 18, you likely have a lot of room to contribute to your TFSA, because this year each Canadian can deposit an additional $7,000 on top of any existing contribution room that you've already filled up. And by contributing early in the year, you can fully utilize your annual contribution limit, giving your investments more time throughout the year to grow. Once you've created your Moomoo account, you can select which type of investment account you'd like to open up. You can go through these steps, and once your account is open, well, then you can make your first deposit from a number of different ways that you can make that deposit, be it in Canadian dollars or in US dollars. Here you can see me purchasing a share of VFV. That's an index ETF fund that tracks the S&P 500, 500 of the biggest American companies, giving me exposure to tons of different companies instead of just selecting a single company and buying a single stock. With Moomoo, you can open up both a TFSA and an RRSP account, and I think it's a great place to do so. If you live in Canada, you definitely know how high taxes can be. The average family ends up paying about 45% of their income on taxes as a result of income taxes and sales taxes, and that's why it's so important that you take control of your finances and take advantage of the admittedly very few tax savings options that the government gives you. Moomoo's trading fees are very competitive, charging less than a cent per share for US stocks and ETFs, with a minimum fee of about $1.99 US, which is significantly lower than the $10, roughly $9.99 or so, that's charged by other brokerages. Now, for Canadian stocks and ETFs, the fee is just 1.5 cents per share. Plus, Moomoo offers a low currency exchange rate of just 0.09% plus $2. So, for example, if you invest $1,000 on Moomoo, you'll only pay about $2.90 in fees, which is 5 times lower than other platforms that tend to charge around $15 to $18. Also, as an added bonus, Moomoo offers an awesome rate on your cash via their Cash Plus feature. With a 6% APY cash rebate, your funds earn interest daily, and you can deposit or withdraw anytime without penalty or loss of interest. This flexibility is great because you could even use it as a place to keep the money for your living expenses so that it's always working for you, earning interest while you're waiting on it. And if you sign up today, you're going to receive a $2,000 commission card. Plus, if you deposit $100, you'll get $50 in stock cash coupons with up to 50% cash back. And if you deposit $2,000, you're going to receive $150 in cash coupons. So make sure you don't miss out on these opportunities with Moomoo, and make sure to use the link in the description to start your investing journey with Moomoo today. So the government of Canada has already spent $30 billion on these mortgage-backed securities, otherwise known as Canada mortgage bonds, with another $30 billion of purchases planned for 2025. But the reason that they're doing so, it's not typical for a government. Now, this action isn't to support any specific policy goal, or at least they're not saying it is. What they are saying, though, is that they're doing this for one specific reason, and that's to simply make a big profit. For the first time, we're seeing the Canadian government take on the role of a money manager or a hedge fund operator, and they're making a trade that could see them pull in hundreds of millions of dollars in the short term, but it does add the risk of losing hundreds of millions of dollars in the longer term. The method that they're using to make these hundreds of millions of dollars is called a carry trade. It sounds complex, but it's actually very simple. And once you understand this one simple concept, everything else is going to make a lot more sense. Let me explain. This carry trade method is otherwise known as an interest rate arbitrage, and it makes intuitive sense. Let's say that you borrowed $100 at an interest rate of 4%. That would mean that over the course of the year, you'd be paying $4 in interest costs to borrow this $100. Makes sense. Now, let's look at it from the other angle, though, because what if you took that $100 and invested it in the markets? And let's say that on average, you were able to earn 5% on that money, giving you 5% or $5 in investment gain. Now, because your investment gain is bigger than the interest costs, well, you end up making a profit here, a $1 profit in this example, because the interest rate that you're paying to borrow the money is less than the interest rate you're earning on that borrowed money, resulting in this profit or this arbitrage. Here's another example of this that some people will do for better or worse. This isn't investment advice. Some people will think, okay, well, I've got some equity in my home. I'm going to borrow $100,000 against my house, and maybe I can get a 4% interest rate on that for this example. Then these people will take that $100,000 and invest it in markets trying to earn somewhere around 7%. As a result, they'd spend $4,000 in interest costs on this home equity line of credit, perhaps, and they would earn $7,000 in the market, resulting in a $3,000 profit. Now, there's a lot of considerations before you go and do something like this. This is just an example, not something you should specifically do yourself. And this is exactly what the government of Canada is doing. They're borrowing money at a low rate and investing it expecting a slightly higher return, which will offset the interest that they'll pay on their loan. And while the difference between their borrowing rate and their investment return rate is slim, they can still make a bunch of of money over time because of the massive size of the investment that they're making. Remember, this is $30 billion per year. This page on the Bank of Canada's website breaks down exactly what the Government of Canada has purchased when it comes to these Canada mortgage bonds, outlining the $29 billion that they spent in 2024. I guess I should be saying 29, that's the real number. 30, I've just been rounding up. They spent $29 billion in 2024, and this outlines all of the individual purchases. Now, the only columns you really need to focus on right now is the dollar amount purchased, as well as the yield. This is the investment return from our example, and the initial spread. This outlines the 8 different purchases that were made in 2024. This one for $3.75 billion, a $4 billion purchase here, another $4 billion purchase. And on these purchases, they got a yield. This is the investment return, ranging anywhere from the high 2s to the high 3s in interest rates. But the really interesting part is the initial spread here, because this is the distance or the difference between the investment returns that they're getting and the cost of borrowing, at least when they first borrow. And this is where some problems come in. We'll get to that in a second. So you can see here, 20 basis points, that essentially is 0.2%, is the difference between the interest rate that they're borrowing at and the rate that they're expecting on the return. So for this $3.25 billion purchase, well, they borrowed at a rate that is 0.45% lower than the rate that they're expecting on the return. This is where they're going to make some money. Now, doing a little bit of back of the napkin math, if we consider that the average spread here was around 0.3% and that they spent $29 billion, well, that would earn them $87 million each and every year. So they could end up making some serious money that they'll say they're going to put towards affordable housing. But I do have some concerns here, because this only works when interest rates work properly for the government. This is interest rate speculation. It makes money right now, but it risks losing money later if interest rates that the government borrows at significantly change in the future. Most of the debt that the government has taken on in order to do this investing is on a 2-year term, while the mortgage bonds that they're investing in will last either 5 or 10 years. Now, when the government needs to pay back its debt or refinance its debt, well, that spread that caused them to make money could end up inverting, causing them to lose money. If today they're borrowing at a low enough rate that this makes them money, well, that's fine and good. But if in a few years interest rates have increased and they're refinancing and reborrowing for these same mortgage bonds, well, then all of a sudden this trade could turn on its head and they could start losing money. In the short term, it seems like they're going to make millions of dollars here, but it raises the more important question in my eyes, which is this the type of activity that the government should be getting involved in? I mean, usually governments will borrow money to fund social programs and other initiatives, not to mention the whole lot of bureaucracy, but that's a story for another day. And by the way, if you haven't already, subscribe to the channel. It doesn't cost you a dime, just a click. It doesn't sign you up for anything. It only supports the channel. So if you're into this kind of content, make sure to do that. But yeah, the government usually will just borrow money to operate, to implement social programs. But now, do we want to set the precedent of the government borrowing to make financial investments like these? I don't know. Maybe it's okay. Is it really all that far off from borrowing to make infrastructure investments that they then hope will one day pay off in increased economic activity and, as a result, increased tax revenues? Is this all that different from that? Well, what do you think? But there is one more important point to make here. Some of you might be saying, well, Russ, the government isn't just risking that the carry trade or the arbitrage could flip against them. They're also risking the possibility of the bonds defaulting if the underlying mortgage payers stop paying their mortgages. Well, what would happen then? And typically, yes, you'd be right. That would be a concern. But in this case, in a roundabout way, the Canadian government backstops all of the mortgages inside of these mortgage-backed securities, only bundling loans loans that have already been insured by the homeowners who have paid mortgage insurance to the CMHC. Now, all of this is a really insular and it's wacky how it works. If you're interested in getting more into depth in it, this is a previous video that I made. I first talked about this subject back in May of last year, and you can check that video out. I'm trying to move myself over, not the whole screen, so you can see the title of it. I'll put a link in the description as well as a card on the video right now. We get into way more depth about how exactly all of that works. But one of the takeaways is that the Canadian government is already on the hook if these homeowners stop paying their mortgages. So the way they see it is, hey, we might as well make some money if we can, while also not increasing our risk all that much, even though they're kind of ignoring the risk of having their arbitrage or this trade flip on its head and end up losing the money. Now, I also worry about the government of Canada crowding out the other price-sensitive buyers from this mortgage bond market. Before the government got involved, these bonds were spread out across a ton of different institutional investors. But now, and into the future, the government of Canada is committed to buying 50% of all of the mortgage bonds that are issued. At first glance, there's not really a huge problem here, but there is the risk of the market becoming more and more dependent on the government to buy so many of these bonds, so much so that the government might think twice or feel pressured before halting these purchases in the future. Like, let's say the government of Canada stops buying them and there isn't enough demand from outside investors that can substitute for this government buying program. Well, that could put upward pressure on mortgage borrowing costs. It happened recently when the Federal Reserve stopped buying mortgage-backed securities. This is the American equivalent of the Bank of Canada. In 2022, they stopped supporting this mortgage bond market or this mortgage-backed security market after largely supporting it throughout the pandemic, resulting in even higher borrowing costs for Americans. So the main thing I think is that we've got to question this type of action. Is this something that we want the government involved in? They're definitely going to make money in the short term. Who knows what's going to happen in the future? If rates change in an unexpected way, they could be on the hook for hundreds of millions, while simultaneously not feeling comfortable backing out from this failed trade due to this major 50% position that they have in the Canadian mortgage bond market over time. It's going to be interesting to watch how all of this pans out, that's for sure. But I'm curious what you think about all of this. Do you think that this is a reasonable way for the government to make money so that they can then funnel these hundreds of millions of dollars into their favorite initiatives of the day, be it more home construction or whatever they're talking about whenever they actually use this money? Or what do you think I've gotten right here? What do you think I've missed entirely? I'm curious to hear what you have to say. And if you haven't already done so, subscribe to the channel. Like I said, it doesn't cost you a dime. It only helps me out, so I appreciate that significantly. But with all that said, thanks so much for watching, everybody. Really hope this video helped you out at least a little bit, and I'll see you next time.